On the weakness in home builders from Ken Zener, senior analyst at Seaport Research Partners. Ken, great to have you with us.
Thank you.
Is it Pool Corp? I mean, should we be worried that higher interest rates are impacting consumers and their ability to get HELOCs, et cetera, and fund renovations, et cetera?
Well, we don't cover Pool Corp, used to cover it, but I would say this, enjoying your conversation, that home builders are an early cycle group. When the Fed cuts, they outperform the market early, which we saw in November into 1Q when we did, we were all in and then we downgraded the group. So we are more focused on quality because if you look at the last 18 Fed cut cycles, 12 of which were non-recession, they outperform the market about 30%, and then that outperformance fades, and that's our current view on the home builders. So we like quality names where net income equals cash flow.
If, though, mortgage rates remain at 7% or so, Ken, because the Fed wants to remain restrictive for longer to make sure inflation is tamed, then will the home builders be subject to, just continued mortgage buy-downs, which will continue to weigh on margins?
I wouldn't say they're already doing it, so I wouldn't say it's an incremental negative. I would highlight, and our work goes back to 1962, the public builders in the 60s and 70s did this, so it's part of their cost structure right now. I certainly don't think there's margin upside as incentives tied to mortgage buy-downs will deteriorate. Historically, if the rates are going down at this point, it's probably because of a weakening economy, which is not good for the demand side.
Well, that's what I was going to ask you, Ken, because it seems like rates are not, as much as it would seem like rates are the entire story, home builders have gone up, rates down, it hasn't mattered. I think it comes down to the unemployment rate. And if I'm right, what is the level where things start to move in a very sort of accelerated fashion?
I assume you're saying accelerated fashion on the downside.
Yes.
Look, we don't know. Of the 18 Fed cut cycles, 12 were mid to late cycle, including 1994-95, when the home builders outperformed, and then they lagged the market. And I obviously cover stocks, so we don't want to be an economist here. But the demand they're seeing at current job levels really can only go backwards. And, they obviously have affordability issues, which is why they're doing incentives. So the risk to return is pretty flat for the group right now. And it's increasingly getting negative, in our view, if you have weakening job or jobless claims, et cetera.
And back to the stocks, right? So what you've said is that these home builders typically do better in early cycle, at least in terms of where you start to see the Fed cutting. In your notes, you actually point out that it's really after non-recessionary cuts is when these things rally a lot, and yet they've given us that rally now. Is that your way of saying this group is a sell? Because, again, I am someone that has been wrong as these things have hit fresh highs, believing that also just the lack of velocity in the space, the consumer ultimately giving ground. But certainly if a house costs 30% more or 50% more in terms of the mortgage at this point, it has to be worth less.
Yeah, I mean, you brought up a couple points there. First, they have had their outperformance. They were up 40%, call it January into March versus the market. They pulled back from that. And in terms of the interest rates, the buy downs, that's already in their cost structure. But if things get worse, and the builders are building quite a bit of inventory, A. B, they are overlapping. So their market share tends to be concentrated in the top 50 markets. So they're all at the same knife fight with each other. And if demand fades, we really want the lower cost, i.e. higher gross margin builders that are able to turn their assets and generate that asset land into cash flow.
Is there, you like the higher end sort of builders as opposed to the first time buyer sort of homes?
No, we look at it quantitatively. So if you're high end, low end, it's how you do your job. So DHI has very good gross margins when you adjust for SG&A and financing costs. And they're a low end builder. So some of the high end builders have clearly benefited, Pulte toll, from existing sellers bringing their equity in. But like Lennar, so we have NVR, Pulte, Lennar. Lennar has a unique story, I believe, in terms of their monetization of their other non-home building assets. And there just was news today about KKR buying a lot of apartment buildings, which we have to get the details on. But that's the type of thing that would convert either, that's not net income, but into buybacks. And it does have a good ROE, which we like.